Can value investing beat index funds in a bull market? Investing strategies can vary greatly, but two of the most prominent methods are value investing and index fund investing. Value investing is based on identifying undervalued stocks, those priced lower than their intrinsic value, while index funds are passive investment vehicles that aim to replicate the performance of a market index such as the S&P 500. Both strategies have their merits, but the question remains, can value investing outperform index funds during a bull market? In a bull market, when stock prices are rising, many investors believe that growth stocks will outshine their value counterparts. Index funds, which are typically made up of a large basket of stocks, tend to thrive in these conditions because they automatically capture the broad market growth. On the other hand, value investing often focuses on stocks that may not be in the limelight during market booms. This article aims to dissect both strategies, analyzing their performance in bull markets and ultimately answering the question, can value investing really beat index funds in these conditions? Value investing is a strategy that revolves around purchasing stocks that appear to be undervalued in comparison to their intrinsic worth. Value investors seek to identify companies that are trading for less than what they're worth, based on financial metrics such as price-to-earnings ratio, price-to-book ratio, and dividend yield. The goal is to buy these stocks at a discount and hold them until the market recognizes their true value. The roots of value investing can be traced back to Benjamin Graham, widely regarded as the father of this investment strategy. Graham's investment philosophy emphasized margin of safety, focusing on companies with strong fundamentals but priced below their intrinsic value. Warren Buffett, perhaps the most famous value investor today, adopted many of Graham's principles and demonstrated how value investing can yield impressive returns over the long run. While value investing is often seen as a strategy for conservative investors, it's not without its risks. The most significant challenge is the time horizon. Value stocks may take years to appreciate if the market fails to recognize their true worth. During a bull market, when stocks in the broader market are rising rapidly, value investors may struggle to see the same level of growth as investors focused on growth stocks or index funds. Index funds are a passive investment strategy designed to replicate the performance of a specific market index. Rather than selecting individual stocks, index funds hold a broad portfolio of stocks that reflect the performance of an index, such as the S&P 500, the Nasdaq, or the Dow Jones Industrial Average. The primary advantage of index funds lies in their diversification. By investing in a single fund, investors gain exposure to hundreds or thousands of stocks, spreading risk and reducing the likelihood of significant losses. Additionally, index funds typically have lower fees compared to actively managed funds, making them a cost-effective way to invest. In a bull market, index funds tend to perform well because they automatically capture the upward momentum of the broader market. Since many of the stocks within the index are rising in value, the fund experiences capital appreciation. Furthermore, the compounding effect over time makes index funds a powerful tool for long-term investors. The main argument in favor of index funds is that they offer consistent returns that closely mirror the market's performance. In a bull market, this consistency can result in significant gains, even if individual stock selection is not a focus. A bull market is defined by a prolonged period of rising stock prices, typically driven by strong economic conditions, investor optimism, and an overall favorable market environment. In a bull market, the demand for stocks increases, pushing prices higher across most sectors. Historically, bull markets have been associated with periods of economic expansion, low unemployment, and rising corporate profits. For value investors, bull markets can present a challenge. Many of the stocks they focus on, typically underpriced due to temporary setbacks, are overshadowed by high-flying growth stocks, which benefit more directly from the rising tide of the market. Growth stocks, often dominant in bull markets, are companies expected to grow at an above-average rate compared to their industry peers. These stocks often have high price-to-earnings ratios and may not always be fundamentally cheap, which puts them at odds with the value investing philosophy. On the other hand, index funds benefit in a bull market because they automatically reflect the performance of growth stocks, which tend to thrive when investor sentiment is optimistic. In this environment, value stocks, while still important, may struggle to keep pace with the broader market rally. Value investing in a bull market is a nuanced approach. While it may seem that growth stocks dominate during such periods, there are still opportunities for value investors. However, the primary challenge value investors face is finding stocks that are truly undervalued when the market as a whole is on an upward trajectory. As stock prices rise, many previously undervalued stocks may become overpriced or be overlooked in favor of more popular growth stocks. In a bull market, value stocks may underperform in the short term. However, the philosophy behind value investing is rooted in long-term thinking. Investors are often willing to wait for the market to correct mispricing, even if it takes years. A patient investor with a long-term outlook may still see significant gains once the market recognizes the value of certain stocks. An example of this can be seen in the 2009 post-crisis recovery. Following the global financial crisis, value stocks, which had been beaten down during the recession, took a back seat as growth stocks, particularly in the tech sector, soared. Yet over time, those who had invested in value stocks saw significant returns as the market corrected. Index funds have historically outperformed individual stock-picking strategies in many bull markets. This is because index funds reflect the overall market performance, and during a bull market, the entire market tends to rise. For example, during the 2000s tech boom, the S&P 500 index posted solid returns, driven by the explosive growth of technology stocks. Investors who had invested in index funds during this period captured much of this growth. The advantage of index funds in a bull market is that they allow investors to capture the broad market's momentum without the need for active stock selection. Index funds provide instant diversification, reducing the risk associated with investing in individual stocks. Additionally, since index funds track the performance of large, successful companies, they tend to benefit from the strong performance of those companies during periods of economic growth. A major advantage of index funds is their low-cost structure. With minimal fees, index fund investors can benefit from compounding returns which further amplify gains during bull markets. Over time, the simplicity and cost-effectiveness of index funds make them an attractive choice for investors seeking broad market exposure. So, can value investing outperform index funds in a bull market? In most cases, index funds will likely outperform value investing during a bull market, especially if the market is driven by growth sectors like technology. Growth stocks, which make up a significant portion of popular index funds, thrive in bullish conditions, leading to strong returns for those invested in these funds. However, value investing is about more than just short-term performance. Over the long run, value investors may see superior returns by identifying mispriced assets and benefiting from market corrections. The success of value investing in a bull market depends on the investor's ability to identify undervalued stocks that will eventually be recognized by the broader market. Some studies have suggested that value stocks may underperform during periods of strong economic expansion, but may catch up or outperform in the long term, especially during market corrections or downturns. Ultimately, value investing requires patience, and in a bull market, that patience may be tested. For many investors, a hybrid approach may offer the best of both worlds. Combining value investing with index funds in a portfolio can provide diversification while still allowing for the potential upside of undervalued stocks. This blended strategy offers a way to balance risk and return, ensuring that investors can take advantage of the broad market growth of index funds while still capturing opportunities in value stocks. A diversified portfolio with a mix of index funds and value stocks may provide the right balance of growth and stability. During a bull market, the index funds capture the market's upward momentum, while the value stocks may offer potential for outsized returns once their true value is recognized. As the investment landscape continues to evolve, many wonder whether value investing can still thrive in today's fast-paced markets, driven by technology and rapid growth. However, despite the dominance of growth stocks in recent years, value investing remains a solid strategy for long-term investors willing to ride out short-term volatility. On the other hand, index funds will continue to thrive due to their simplicity, low fees, and ability to capture broad market growth. With the rise of exchange-traded funds, ETFs, and advancements in passive investing, index funds are likely to remain an attractive choice for many investors in the future. The behavior of investors during a bull market can often skew expectations and performance, especially when comparing value investing and index funds. Investor psychology plays a significant role in both market movements and individual strategy outcomes. Let's break this down. Investor sentiment and its impact on value stocks. During a bull market, investor sentiment often tilts toward growth stocks. The allure of fast-paced gains and the media's focus on high-performing tech stocks can push investors to overlook fundamentally strong companies that may be undervalued. Value investors, often seen as contrarians, may struggle to gain traction when the market is driven by optimism and future growth projections. In such environments, value stocks tend to be out of favor, leading to underperformance in the short term. This creates an emotional challenge for value investors who may question the wisdom of sticking with undervalued stocks while the broader market rallies. The psychology of index fund investors. On the flip side, investors in index funds generally benefit from the market's upward momentum during a bull market. They don't need to worry about stock selection and are insulated from the stress of finding undervalued gems in an overheated market. Index funds' passive nature and low maintenance can offer peace of mind, particularly in environments of strong economic growth. In this way, investor behavior plays a positive role in index funds' ability to match the market's performance. Investors simply set it and forget it while benefiting from the bull market. Behavioral risks for both strategies. Both value investors and index fund investors face different behavioral risks. Value investors might fall victim to overconfidence or anchoring on a stock's past performance, which can lead to holding underperforming assets longer than necessary. Meanwhile, index fund investors might fall into the trap of herding behavior, overestimating the safety and certainty of their investments and ignoring potential market corrections. In the end, emotional discipline and adherence to a well-thought-out strategy can determine the success or failure of either approach in a bull market. One of the most compelling real-world examples to analyze when comparing value investing to index funds in a bull market is the 1990s technology boom. This was a period characterized by rapid growth in the technology sector, where the internet, dot-com companies and Silicon Valley innovations drove much of the market's performance. The rise of growth stocks. During this period, tech stocks soared, and the overall market saw strong performance, pushing major indices like the Nasdaq and the S&P 500 to significant gains. Investors flocked to growth stocks, particularly in the technology space, which led to massive market rallies. For index fund investors, particularly those holding funds like the Nasdaq 100 index, the returns were spectacular. The struggles of value investing. Meanwhile, value investors faced difficulty. Many of the traditional companies they favored, such as those in the industrials, utilities, and consumer staples sectors, lagged behind growth stocks. Even value stocks with solid fundamentals struggled to keep pace with the explosive growth of the tech sector, leaving value investors with flat or modest returns in the short term. However, as the tech boom eventually hit a wall in the early 2000s, during the dot-com crash, the tech-heavy indices plummeted. Those who had invested in value stocks during this period, especially in companies with strong balance sheets and low valuations, were able to recover their losses quickly. Long-term value investors saw strong returns once the market corrected itself and growth stocks were revalued. The lesson from this period is that value investing may underperform during specific market rallies, but over the long term, it often proves to be more resilient when a bubble bursts or when growth expectations correct. While both strategies, value investing and index fund investing, perform well over the long term, timing the market cycle is a key consideration. A bull market by nature is not infinite. Understanding where you are in the market cycle can help you decide which strategy might be more appropriate for your portfolio. The impact of market cycles on value investing. During the early stages of a bull market, value stocks may underperform as investors pour capital into high-growth sectors. However, as the market matures and starts to show signs of overheating or when certain sectors reach their peak, value stocks often begin to perform better. This is especially true when investors begin to reassess stocks with solid fundamentals that were previously ignored in favor of more speculative investments. Index funds during market cycles. Index funds, by their very nature, perform in line with the market. This means that during the middle or later stages of a bull market, as indexes expand, investors in index funds will continue to capture broad market growth. However, if the market enters a period of volatility or a bear market, index fund investors may experience a sharper downturn as the market as a whole falls. In a market downturn, value investing often shines. The stocks selected by value investors, especially those with strong earnings, low debt, and a solid market position, are more likely to weather a bear market than growth stocks, which are often more sensitive to economic shifts. Timing the transition from bull to bear markets can be a powerful tool for value investors who are likely to see their holdings perform better when broader market conditions favor stability over growth. While index funds are likely to outperform value investing during a strong bull market driven by growth sectors, value investing holds unique advantages for long-term, patient investors. The challenge lies in understanding that the performance of value stocks often lags during periods of rising optimism and economic expansion, but they can offer significant returns when the market corrects itself or experiences a downturn. Ultimately, whether value investing or index funds will be more successful in a bull market depends on your investment goals, time horizon, and risk tolerance. If you're seeking consistent growth and low-maintenance investing, index funds may be the right choice. However, if you have the patience to hold undervalued assets and the discipline to weather short-term volatility, value investing could offer greater long-term rewards. For those unsure of which approach to take, a blended strategy of combining index funds and value stocks might offer the best of both worlds. In a bull market, index funds capture broad market growth, while value investing provides the opportunity for outsized returns as undervalued stocks are recognized by the market. With a hybrid strategy, you can diversify your portfolio and tailor your risk exposure to match your financial objectives. As always, understanding market cycles, investor psychology, and maintaining a long-term focus will be key to any strategy's success. Regardless of the approach, successful investing comes down to making informed decisions and sticking to a strategy that aligns with your goals. Please be sure to like and subscribe to the Dollar Donkey channel for more value investing insights. Until next time.